All right, well, hello everyone, and welcome to our webinar today. Thank you for joining us to talk about private markets in 2026. Today we'll be diving into a few trends on macro trends, ESG shifts, AI innovation, and what it all means for deal flow. Just a quick note on our speakers today. We have Benjamin Krush, who is the strategy director at Clarity AI, and Sylvan Forte, who is the CEO of SESAMm. Please keep in mind that this webinar is being recorded, so anyone who couldn't make it today, or if you'd like to watch the recording later, we will certainly send it out and you can share that with your colleagues. Everyone is on mute, of course, but please do add your questions to the Q&A at the bottom. We'll keep an eye on it throughout the webinar, so feel free to drop them in. We'll get to as many of them as we can at the end, and then, of course, follow up with anyone that we can't talk to during the webinar. So with that, I'm going to hand it over to Sylvan and Ben.
Thank you very much, Megan, and nice seeing you all on the webinar. Thanks a lot, Ben, for this session together. So we have quite a busy plan for the session. It's looking back at 2025 trends in private markets in general, as well as in ESG specifically, and our 2026 outlook. And so maybe to start with, happy on my side to kick off the conversation and tell you a bit about our perspective on how private markets have changed in 2025 and potentially what to expect for the future. So I think from our perspective at SESAMm, dealing a lot with private equity firms, which are some of our main clients for due diligence and portfolio monitoring as well, GPs, LPs, secondaries fund and the like. Some of the main things that we saw at a macro level is lots of dry powder, valuation resets to an extent, and a reduced number of deal counts. And I think that's pretty obvious, but what happens operationally in that context is that the level of selectivity is increasing. And so we see a much higher focus on due diligence stages. So due diligence is getting more and more complex, more and more detailed, and that has had an impact on the ESG front, where the requirements in terms of KPIs, analytics, and in the case of SESAMm, checking for any reputational risk and controversy data on private companies and infrastructure projects has massively increased. And oftentimes, timing is a bit less of an issue, at least in direct investments, because assets tend to take a bit more time to be selected. And so that means private equity firms are also spending a bit more time doing due diligence internally before spending with external consultants as well as law firms. And so they use our tools and other tools in order to do a lot of work internally to get to know the asset itself, to raise questions to the management team. And so that's definitely something that we have seen. And similarly, companies tend to be held in portfolio for a longer time. And so that need for information has already increased on that front. Oftentimes there was a perspective that for direct investment, deal teams would provide sufficient information and management would provide sufficient information on portfolios. But as the time scale is expanding and the duration of these investments continues to grow, we see that this has been a real change in terms of making sure that there are no emerging operational risks that would not have been captured at the diligence stage, emerging governance risk, litigation, and reputational risk exposure. So I think in terms of direct investment, the main take from 2025 from our side is there's really that information advantage, not capital advantage, that has been building up, where now it's about taking their time in order to make a transaction, getting as much insight as possible on each specific target. And when a portfolio company has been held for quite a long time, making sure that the monitoring process is in place from that perspective. And the two other things that we saw, we've seen a huge increase in secondaries. So I don't think that would come as a surprise. But again, there is an operational element to that, is the number of transactions is increasing. And so the burden in terms of due diligence, including sustainability due diligence on secondaries transactions with hundreds or thousands of lines has increased. So we really saw that firsthand in terms of the number of deals going through our platform on the secondary side. And the last thing is supply chain. So supply chain resilience has been a big focus for a lot of corporates across geographies, but including in the US, where there has been a big focus. And we have seen in 2025 supply chain making its way in due diligence itself. So an example here is one of our major clients in the US, a law firm, is servicing private equity deal teams, so in transaction services, and have now included a lot of supply chain due diligence insights, making sure that at least tier one suppliers were known and evaluated when considering a global transaction, and sometimes going as far as tier N mapping, so going down the line of the suppliers and the like. So that goes with the increase of the scrutiny during the due diligence phase, which has been quite critical in 2025. And maybe from your perspective, Ben, and thanks again for joining us from the Clarity AI side. What stood out in private markets on your side on the ESG and risk practice?
Well, very happy to be here, Silva. It's a really interesting topic that's also showing a lot of movement on our side. And I think you mentioned a couple of really key points that we observe as well in our client base. We have a mixed number of clients, like we have like the classical large asset managers, but also we have lots of GPs and LPs directly. And I think one of the points that you mentioned really struck out. It's this idea the classical point in time due diligence really is breaking down, and what people are moving towards is a much more continuous updating of the initial thesis, a continuous monitoring of this risk as well. And that comes with, I think, three key implications that we see from the sustainability side as well. I think ESG sustainability data traditionally was very much a reporting burden you needed to do. There was 23, 24. This burden is still there, but I think the market is kind of separating into people that say we just do it for reporting. And the second one, actually integrating this a lot deeper into their investment layer and taking the financial materiality lens a lot stronger in private market as well to bring like the data points that matter. You mentioned supply chain resilience. I think geopolitical risk is a second one. Physical risk comes to mind. Really deep into their decision processes rather than just having it as a separate reporting layer post fact. And I think the second point that struck me is that this drives a lot more need for high quality data than before. When prior you were happy with some high level estimates or benchmarks, now what we see is that our clients are much more asking for directly collected data, for proper quantitative KPIs, for data validation at the point of engagement with this company, rather than like some benchmarks they can apply post fact to them. So really this shift from reporting to integrating it into the due diligence and making this due diligence continuous in the monitoring of risk is something we're seeing a lot. So when you look at this from a split between private markets versus public markets, do you see there's a gap opening in how they see sustainability and ESG, or do you think they're becoming more similar?
Yeah, I have to say I've been a bit surprised. So we do both public and private markets. So we deliver controversy insights on large caps, small caps, high yield, and millions of private companies and infrastructure projects. And I was really expecting that the convergence would happen fairly quickly. But I think what's happening is it's a bit of a data element where it is very tough to have methodology converge until there are global offerings that cover both market at once. And so, fortunately or unfortunately, I haven't seen as much convergence as I was thinking. And so part of it is coverage is very different. So that's very clear. And so it limits the ability, for example, with large rating agencies to cover all markets at once. But it also has an impact down the line. Is like for LPs, there is actually a fragmentation of ESG expectations to an extent. And so we see still a lot of quite bespoke ESG workflows. So for example, I was mentioning on secondaries. On secondaries, we do a lot of customization of exclusion categories. So there are all of the main ones is how are the transactions exposed to the tobacco industry and fossil fuels and predatory lending, for example. But we then get requests for custom exclusions due to a specific LP which is like pork-related activities, because there's, for example, a UAE investor or say crypto assets, for example, due to a specific perspective of that fund or that GP in general. And so, due to these fragmented LP expectations, GPs have to report in a number of different ways, unfortunately for them. And I think the focus is becoming more not necessarily standardizing everything because they do not control all of the LP requests, but trying to standardize these unique workflows so that at least the customization parts happens once, the workflow is designed once, and then can be executed systematically on a day-to-day basis. So we work quite a bit with clients on that. But that's still one of the big topics. I would have expected that to be kind of solved in the industry some time ago. There's still a lot of convergence initiative. I think EDCI is a very good example, but there are still quite a few limitations, and it will probably take a lot more time than I expected in the market. And I think the work that Clarity is doing and with SESAMm and everyone is good in that perspective as well. Public markets are well equipped in terms of sustainability data, and there is a lot to learn actually in private assets. So we can commonly bring that perspective and help private investors get more and more standardized data, standardized workflow to the extent that the LPs allow for that.
It's a very, very good point you're raising. So coverage in private markets is definitely an issue, especially when it comes to publicly available information. At the same time, with the tech that you're also offering, SESAMm, I think clients can get a lot more ESG, a lot more risk data, and more data than they've ever received before. Like, do you see it actually always driving clearer decisions, or is it sometimes also just increasing the complexity of coming to a yes/no decision?
No, we're seeing that in a very positive way. So I think there's always that balance between coverage and information overloads. That is really something that needs to be handled. And coverage is still key at the moment in private markets due to the lack of convergence. Most of our clients in private equity or let's say banking CIB or corporate banking and the like, they would come to us because they haven't found a solution that properly covered their portfolio of assets. And so at SESAMm, we cover around 5 million assets. And that is oftentimes the key decision-making processes. At least we need information on these companies because I used to use another provider and nothing happened on my portfolio that was not perceived as a positive thing. And then the notion of quality of data is very, very important. And we address it in a way that is quite similar to traditional rating agencies, but powered by AI. So we have our own severity score that tracks like the financial materiality of a controversy, the operational materiality, legal materiality, number of stakeholders impacted, and the like. And so we work in a very qualitative work, not just quant insight, but qualitative work. And so that allows us to see controversies that are critical emerge and get alerts at the right point of time when the issue really becomes material for the company itself. But that has been work that we've been doing for quite a long time, and that requires also a real methodology team in the background, because otherwise controversy becomes adverse media, and adverse media has that notion of like lots of duplicates and same information but in different languages, etc. And so we did a lot of work to aggregate the insights. So I'd say coverage is really key. Like most of the time, that's the differentiating factor, provided that quality of data, aggregation of insights is done well. And then that becomes a very, very powerful process for investors and doesn't create like information overload. It's just they would then be able during due diligence to surface insights that would then be used for the pre-commercial due diligence, and they can guide the consultants in the right direction, and they can flag the right things during secondaries due diligence transaction, and they can find issues that deal teams have not found once the companies are actually owned. So that creates a very positive process. And on your side, Ben, how about the notion of reducing uncertainty versus creating noise, and how do you see data doing that in action in your day to day?
I think on the reducing uncertainty, so on making sure you can make better decisions. The point you make around higher coverage and consistent monitoring over longer time points, not just point in time, really is a really good one, especially as it also then increases the comparability across your different portcos, across your overall portfolios if you manage different funds. And that helps you ultimately get a clearer view on where you are in terms of risk that you're carrying, of unseen risk that you might be carrying. I think where a lot of our clients I see struggle is that with increased data, the traceability of that data and the quality of the sources of this data hasn't necessarily increased. And this is where I think your point you're mentioning around how do we not just take adverse media into account, but actually figure out the real controversy. This is then where tech plays an important role. How do we differentiate between this is just a news article that popped up in the day, but it doesn't matter, versus this is actually a news episode that will turn into a proper financial material risk. And I think what this does, at least I see this with our private market clients, they're moving much more into specific areas they're monitoring rather than saying we're going across the entire field of potential controversies. So they have very specific governance risks they try to monitor with news screening. They try to monitor also with more quantitative metrics. They're looking specifically at physical risk associated with water shortages, floods, etc. on their portfolio. So the risk thesis becomes much more specific and less a general, is this good or bad ESG score? On your side, you mentioned secondaries a lot. As a field, like, we all see them massively increasing in volume and transactions. How do you see sustainability data, ESG data being used in these deals?
Yes, secondaries is a bit of a new use case for us. We launched this last year because we had a lot of demand from large investors in Europe and US, in the US. And it's a very practical use cases because a secondaries deal team would get a deal. There's 150 lines to analyze, and they need to provide a response in 24 hours. And so the number of assets is fairly high. You can't, of course, due diligence sort of the companies. Your access to the company is very low, so you don't know anything about them in some cases. And so it's really just time consuming. And so when there's a manual time consuming process, there's oftentimes an opportunity for automation. And so we launched an AI agent dedicated to secondaries workflow, specifically for exclusion screenings under that time pressure that they're having. And so in practice, secondaries investor, what they do, and LPs have the same process, and credit investors as well, is they input a portfolio of any company, any infrastructure project, say that 150 different companies. Sometimes they have limited information. There's no identifier on the companies, etc. So the workflow needs to be very, very smart to identify the right companies. And what they receive as an output, and I'll show it during the demo, is a list of the exposure of each of these companies to the specific exclusion themes, such as that predatory lending theme or sanctions, for example. And so it gives them the ability to perform a process that in the past had been performed using manual Google searches, for example, which not only was very time consuming, but also risked missing quite a bit of information. And in practice, what we saw is just the number of deals increasing way beyond what we were expecting, which is driven by the market itself, but also because there is a lot of value. Like when you can replace a lot of manual process with some AI automation, adoption is pretty high on that front. So that's one of the big use cases I think that we kind of discovered in 2025 that has been ramping up quickly. And it's also great because a few years ago we never saw the secondary sustainability teams, etc. I feel like they were a bit hidden, and a lot of the ownership was from the direct investment teams. But now they're getting a lot more ownership and budget and have the ability to invest. And then we have our traditional use cases, which are more direct, but also monitoring, especially for LPs, not just GPs. So due diligence, where we also have agents for generating a full due diligence AI report on ESG themes, not just controversies, but also disclosures, and monitoring day-to-day portfolios, either as GPs to capture information that may not be reported by management, or by LPs who, like secondaries team, do not have a ton of visibility in the portfolios, and so that public data is quite helpful. So I'd say that these are the three main things and use cases where we see data in action. So secondaries is a new one, and more traditionally for direct investment and also LPs, monitoring of portfolios as well as due diligence.
And I think it's this consistency of assessment at scale that you mentioned that really helps in the secondary case. You can have your really personalized risk thesis, but you can build this on a tech stack that actually makes sure it's not the individual analyst Google search. It's something that's repeatable at scale and gives the same results no matter when you run it.
Yeah, exactly. And I want like on secondaries, it's one thing where we see some needs for customization because the teams have a client in the background that has a specific perspective. But as long as it's done once and then for the entire relationship with that client, they can perform the screening in the same way for every single new stake that they are taking, then that becomes a very valuable process rather than having to redo all of the work every day. Yeah. And from your side, Ben, I think a big topic we all have in the industry is kind of moving away from pure reporting exercise in ESG. How have you seen that happening in 2025 and towards more risk, decision support lens rather than pure reporting ticks the box?
I think the reporting debate has definitely not ended in 2025, and we've got the SFDR change coming up as well in the next, who knows, 2 or 3 years, that will change all of this again. But I think at least from our clients, the basic reporting that caused a lot of headaches 3 or 4 years ago is a solved problem now. Most of the clients we know, they have either proxies or the extra collected data. They've done it a couple of years. This pure box ticking, people realize A, doesn't add a lot of value, and B, wherever they can, they try and automate it, either using like external providers like you and us, or actually they've built their own workflows internally. And I see a lot of the ESG teams much more focused on like financially material topics. So it's also on the private market side, looking at how can we use ESG, non-financial sustainable data, for like getting the right price for a deal, like managing the risk, managing downsides. But also on the upside sense, how can we use information about the revenues generated in the sectors this company works on, to find markets where like growth comes at a premium. So the whole decarbonization economies, any enabling suppliers for solar panels, etc. We see this data being used more for the decision making, and lots more interest in this as well. And that comes with I think with two sides of this. One is, as you've already mentioned, and we're both mentioning a couple of times, this continuous monitoring of this rather than assuming a point in time score is good enough. And the second point, absolutely around tailoring of this, because every client comes with their own investment thesis. They all come with their own risk thesis. And that requires to have systems that are flexible enough to really tailor it specifically to this, rather than having the old idea of we can categorize companies in either good or bad with a simple score. Realistically, what's your view in terms of the kind of biggest gaps? We're now talking in this ideal world where everyone has access to this data. Like when you talk to your clients, where do they struggle in terms of data, in terms of expectations on what ESG data or sustainable data should do?
Yeah, it's the first one is the obvious one. It's still the same private company disclosure gaps, so no access to information, and it's expressed in different ways depending on where you are in the financial industry, GP, LP, secondary team. So that's why we're striving in the markets is deep access to public data, and the outside in view is a good proxy and a good way to access information, including very deep, very local information, without having to go through like reporting processes and as well as questionnaires. So this one is the obvious one, and it's still a gap. Like will probably not be solved anytime soon. Second part is supply chain. So there's still a lot of opacity in supply chain. We work with some great partners on this, in particular Sayari in the US, as well as another large partner, mapping suppliers, identifying, say, like a sweatshop, for example, in Asia, in the value chain of the company. So it's a problem not just for private markets, but it is becoming more important in general, and specifically when it relates to human rights issues. So forced labor, child labor. There's a regulatory perspective, but there's also really a financial materiality and reputational perspective on these items. So I think these are still the main considerations on that front. But again, I don't think we can like blame private markets, etc. It's due to the structure of the market, and the topics of supply chain opacity are exactly, if not more critical in public markets in reality. And on your side, on the disclosures, supply chain opacity, inconsistent LP demands, so some of the topics that we discussed. How do you feel
I,
like regulatory frameworks are changing expectation, like CSRD, SFDR in practice?
it's two very big topics. I think supply chain is something I'm quite excited to talk about in terms of where this goes and the potential that also lies there for using a more tech-based approach to actually removing some of the opacity and mining the huge amount of data that we have. Regulation on the side, maybe less excitement from my end. I think it's caused a lot of market uncertainty. The CSRD rollout, then stop the clock, now turning this all back again, as if they are changing like the EU taxonomy reporting, which is like really highly standardized data set, not really gaining the traction we want. So while I think initially, at least specifically on private markets, the regulation really was driving data demands via the LPs to the GPs to the portfolio companies. I think the world has now gotten a lot more complex in the role that these regulations play. And when we talk to some of our clients outside of these regulated areas, so if we go to the US, where nominally ESG is a persona non grata, and you can't use these three words anymore, what you actually see in practice is that they are further along in integrating this in their IC workflow than they are in Europe, because they're less focused on changing to the latest regulatory change, and they're more focused on the topics you mentioned, like how do we find financially material risks in the supply chain, in our portfolios, in headlines, etc. So it's an interesting interplay for sure. And I think especially the kind of interaction between LPs and GPs day to day are quite critical. I'm sure you see this a lot on your side as well.
Yeah, absolutely. And then there's the big topic, and we can skip ahead a bit on everything AI as well in 2025. And maybe what I can do is we had a short demo planned, so I'm happy to cover some topics through the demo on my side, and I also have then a few questions for you as well, Ben, on what you've seen in the market and how you've seen adoption of your own AI tools and the different trends. But let me share my screen for a sec, and this way, hopefully, I can make that as tangible as possible on how AI is impacting workflow in private markets and ESG, and how we integrate it in our own platform. And keep in mind that a lot of things here are relatively new. Actually, there's a lot of developments that were not possible before 2025. So that's quite exciting. Right, so let me check if you can see my screen. Perfect. All right, it should be okay now. So I wanted to first cover just the controversy side. And the first thing I want to say is SESAMm wouldn't exist without AI, simply due to the core value proposition that is tracking millions of private companies. So here we have a typical example. There's Packer Sanitation Services. the company is owned by a private equity firm and has been exposed to a number of different topics. So we track these underlying events, and PSSI faces backlash over child labor violation. That event being tagged as child labor, there's a forced labor topic as well, and with a specific level of intensity or severity to highlight critical events. And so keep in mind that here we aggregate all of the topics, all of the events, so as to make it very, very easy for investor to identify that single topic very rapidly and to have it merge. So coverage, absolutely key. And AI is enabling that across 100 different languages and 4 million sources. So we can dive into that information. We get a summary that, again, is powered by AI. We see all of the different sources, all of the underlying events that relate to that specific controversy. And based on these events, we can then generate scores. We can see over time how the risk score and how the number of controversies has evolved over time. We can assess the main topics related to the company. We see here child labor, forced labor topics being a very deep red from a heat map perspective. And we also have modules for more regulatory topics, such as UNGC violations. So here I gave you another example on Elbit systems, where we have a number of UNGC watch list and violation events related to both corruption allegations and potential war crimes allegations. And so again, a lot of this is powered by AI that has been fine-tuned for these specific processes with our specialist ESG methodology team. And so that's the core AI element. But what happened in 2025 is that we could really start doing AI agents in production. So SESAMm currently has 6 different AI agents. And here the workflow is a bit different. Like a company looking at a due diligence use case would simply have to input the name of the company or the infrastructure project, and maybe a kind of identification like a website, a unique ID, or a description of the project so that we can identify it in our database. And based on that, the AI agent is generating a full report. So this is an example on a European company. The system in 15 minutes generates the full ESG due diligence report, around 40 pages, from an initial summary to analyzing all of the controversies themselves. Okay, so here are the key topics. There's animal welfare violation, pesticide use, etc. And as well as the affected regions, controversial activities when relevant, industry topics. So what are peers exposed to in terms of controversies and what are major regulatory changes to the market. And we even have screening of frameworks, norms, as well as entity disclosures. And entity disclosure is something we couldn't do without AI because we extract that information directly from the company's own website, looking at their latest sustainability report, or their board member composition, at whether they have specific GHG emission reports and the like. And so that's very, very deep practical information that is already structured. And that's really the types of use cases that were only made possible in 2025 with the latest AI model. And similarly, I mentioned secondaries quite a bit. So secondaries has that use case where we have a list of companies, say that 150 portfolio that is a specific GP stake, and we need to screen for specific exclusions. And so similarly here, we use AI agents leveraging all of the data that we have in order to identify potential significant involvement in severe human rights and labor violations or predatory lending, with all of the justifications, summary, detailed contents, and the like. So that's really, I think, the main thing that has changed from our perspective is the use of AI agents that can do a larger portion of the work now. Controversies is accessing insights, but AI agent allows investors to go deeper up to the initial stages of the full reporting process in a very automated way. And I think that's again, in terms of time, that is very, very practical and very immediate for investors. So adoption has been quite huge on that.
And I think
on
the
your
output
side,
you
Ben,
showed
sorry.
there, sorry, I was too excited about the topic because I think what you showed for me summarizes quite nicely what has really changed in 2025. Like we started in a world of chatbots based on the foundational models, and what people realized is that you can get a lot more value out of the work with AI if you actually specialize in a specific vertical and you tailor those foundational models to the exact use case by implementing like RAG retrieval to get actual data in the background and making sure they have access to your data, by tailoring the outputs, etc. And this way, you moved from a, I think, fairly intransparent system, where every answer was generated differently and you couldn't really control it, into a place where now I fully agree with you. I think the stability of those AI agents to autonomously perform a task, the validity and the transparency you get on the data underneath is there to actually take huge chunks out of the typical due diligence workflow and automate a lot of them as well. I think it's a very good way of showcasing this. It's kind of the move from chat interface to ready-made like investor grade output that has really changed.
Yeah, absolutely. And stability is very key, like you said, because if you generate like a due diligence report, but the risk categories change every single time and you're not sure what has been checked or not, it's a nightmare. And so it does help, but not as much as having a workflow where you control everything. And same when you screen for a company, if you get a different response every time, that becomes quite problematic. And I'm curious on your side as to what you've seen in terms of successful use of AI plus ESG data in practice.
I, it's it's a good question. I think we talked about a couple of topics already. Like this idea to be able to continuously monitor the evolvement of risk of a company over hundred thousands or millions of news sources, over multiple disclosures, over the entire supply chain was utterly impossible before the age of, you can call it AI, you can call it tech, whatever you want to call it. Basically, it's not possible to do this with human labor. And that's really an incredibly successful human use case. What we are seeing on our side now is that a lot of the clients we talk to are starting to move from this like initial adoption, which was really focused around like just being more like faster and being more efficient than they were in the beginning, to developing or co-developing with us AI-based systems that move beyond this initial layer of uncovering data by actually making connections that a human analyst wouldn't do. So like we have a lot of LPs that have like a wealth of unstructured data sitting um, on their servers, like sitting through past all the past due diligence they've done, etc. And being able to take all this unstructured data and uncover these risks at scale. I've mentioned the example of geopolitical risk. I mentioned supply chain risks. Plus, the news monitoring really helps you it gives you the ability to not just look at the 3 or 4 major risks that you want to track, but analyze the entire long tail. And that's really shifting the way these companies think about their own portfolios. They think about risk and they also think about what's possible using those AI tools. You mentioned stability is a key thing. I think the second bit that I see in high demand is the kind of traceability of this output. Like, how do you make sure it's like reliably from an existing source? How do you trace where it's coming from? How do you surface this for the user as well? And at least on our side, those workflows, yes, they're automated, but the decision is typically still the human in the end. So they stop at the point of this is the final report, and now you human, you've got the data nicely structured and valued for you, and you can start then making a decision on this in an hour rather than 2 weeks before.
Definitely. And maybe to close these topics, let's look at 2026. So I'm interested in hearing from your perspective by the end of 26, what will look outdated maybe about how ESG and risk is handled in investment process. What will be like, okay, this is so 2025. It'd be interesting to have your perspective.
It's a great question. I'd be interested to hear your perspective on this as well. Let me highlight, I think, 3 things. We've talked about this idea of continuous monitoring. I think the traditional world of we do it due diligence once and then we leave the package as it is will look very outdated at the end of this year. And people will move into much more continuous fluent monitoring of this risk and not an upfront risk assessment, and you leave it at this. I think the second point that goes along with this is that from a sustainability perspective, the idea of only monitoring once a year disclosed data points and leaving them stable for public companies, or actually relying on once a year collected data points from private companies, will look very old-fashioned. And it will be a much more dynamically evolving view that uses the same static information, be this physical, like asset location, be this the supply chain, but overlays this with an intelligence layer that looks at what's happening in the world, what's happening in the news. And based on this, you can then reassess on a portfolio level quite regularly what's happening. I think these are the two major things that will look very much so 2025. I like that question. What's your view? What's going to happen in 2026?
I think there's an element that is both technology and political, which is the boundaries fading between ESG, reputational risk, KYB, KYC, supply chain, for good or for bad. It's something that we all have to adapt to. And we've seen a lot of demand from people completely outside of the sustainability world, especially in supply chain now, because supply chain does care about human rights issues, for example, and there are another set of regulations that apply to this. So I think this trend will continue, and which could also put pressure on sustainability teams as they get sometimes, and we've seen that like merged into other teams and have to work on different processes that are not purely sustainability focused. But this is a trend that I think will probably continue in 2026. And that means also for us, we have to adapt as data providers because platforms will be expected to serve multiple use cases from one data layer. And agentic workflows are a very good tool to enable that. Using the data and then adapting that for a specific use case that one day is more ESG due diligence focused and the other day is actually supply chain risk focused. And related to that, what will probably continue in 2026 is that the barrier between consulting and SaaS continues to fall. Consulting firms, ESG consulting firms are big clients of SESAMm, and we see that they are sometimes under pressure because clients have lower budgets in some cases, and because they are relying more and more tools. So I think it's good also that consulting firms continue to absorb as much technology as possible so as to be able to focus on the high value tasks. And that trend, we've seen consolidation in the market everywhere with ESG consulting firm. This is unlikely to stop in 2026. And yeah, lastly, I think private markets is going to continue to be an early adopter on a number of different topics in both ESG and AI. So the fragmentation of processes also leaves a lot of room for innovation. So there are a lot of good ideas that are coming from private markets. So I think we'll have a very, very interesting year on that front. And so yeah, looking forward to it and to seeing what 2026 has in store for us.
All right, so I think we can go ahead and jump in for a few questions. We are almost out of time, but please do feel free to keep adding your questions to the chat and we'll get to as many as we can. The first one is looking at metrics. So in terms, what is a specific metric that your clients are using if they want to measure their return on investment for when they use AI-enabled tools?
From our side, there are two. So the first one is just financial returns. It's oftentimes easier to compute in public markets. So backtesting and live trading performance is quite key in that front. In private markets, there's always like a longer term on that front. And the second thing that has become more critical in 25 due to AI agents is time not spent on manual tasks. And like the secondaries workflow we described, that's exactly like the key point there is I just automate 80% of my work and that's very tangible for these teams.
I agree. I'd add two maybe more quantitative things. Like what I see very often on the PE side is it's the cost per TD. Really simple. Like if you're using AI tools, one of the thesis you almost always have is, does my manual work reduce, as you said? So does it mean I'm actually saving cost? And the second is the less during the DD phase, but afterwards, the coverage per analyst. Like what number of assets can we cover per FTE? And the thesis here is instead of the traditional 30, 40 or so, you can move to hundreds. And I guess you see this on the secondary use case specifically, with the same depth and data granularity without increasing cost or increasing your analyst team.
All right, thank you. And so let's see, one more question. We have looking at the fragmentation of ESG expectations across LPs. How do you see fund managers efficiently manage multiple bespoke requirements?
With pain sometimes, I have to admit. So it can be very difficult for them. Oftentimes, again, the expectations cannot always be avoided. So there is sometimes pushback from GPs that say, okay, realistically, we cannot provide this information and we cannot guarantee that specific disclosure as part of the investment. And I think a lot of LPs are open to these conversations in reality. And then when the expectation is there, it becomes more about automating parts of that work that is required and making sure that it is done once during a design phase of a specific workflow, AI agent tool, SaaS system, and not every single time there is a new transaction. So yeah, sometimes it can be avoided, but when it can't, tools are a good way to get leverage.
There's one more. Do you want to take that one, Sylvan?
Yeah, there was one. Can we assess high-risk issues with supplier mapping beyond tier one using SESAMm? So yeah, definitely we do quite a bit in supply chain. Usually we rely on our partners such as Sayari and Dun& Bradstreet for the mapping itself, based on like shipping data, payment data, and the like, and we provide the controversy insights on this. So it's something that we do every day, and we have become quite a strong player in supply chain analysis specifically. So yeah, happy to have a discussion if that becomes of interest. And in general, as I know we're closing the session, I would very much encourage you to reach out to our partner, Clarity AI, as well as to SESAMm, if you feel that some of these topics could be of interest. We have a very good partnership, and we commonly address private equity clients' use cases with our own offerings. So yeah, please feel free to reach out to either teams, and we're very happy to give you a demo and see what parts of the solution fits your needs and to work collaboratively.
All right, thank you. I think we better wrap it up. We're a little past time, but thank you both, Ben and Sylvan, for your great presentations and everyone for joining us today.
Thank you, Megan. Thank you, Ben. It
Been a
was
pleasure.
great.
Thank you, Silva. Thank you, Megan.